Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity.
Welcome back to another episode of Equity Mates, a podcast where we explore what is possible in the world of investing. Now, if you've just joined us for the very first time, a huge welcome to the show, to the Equity Mates community, and to the journey of investing. We have a huge episode to get through today. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. I'm very excited for this episode. Now, I know you're getting a bit older, but I want you to cast your mind back to when you were a young, sprightly 20-something-year-old.
Last year.
Back to your 20s. No, not last year.
Yeah, I'm early 20s.
And in your 20s, there were some amazing stock stories. There was Afterpay, but the number one meme stock has to be the company that we're talking about today. And I know it's a long way for you to cast your mind back, but it captured Australian investing minds.
Yes.
Today we're talking about Zip.
Zipco.
Somehow shoehorned a sledge of your age into there.
That's right. Yes. Zipco, the ticker
Zip.
ZIP,
You're not going to forget
listed on the ASX. Did it certainly capture the minds and imagination of many investors back when buy now, pay later was absolutely ripping. And yes, we're unpacking it today.
The thing is, though, it's ripping again. And the question is this rally sustainable? Are we back to Bryce's 20s and the year of 2020 and 2021? Or is this a blip? And luckily, we're not going to try and answer that ourselves.
This series wouldn't be possible without the support from Superhero Super. Superhero Super is a low-fee, award-winning super fund with a wide range of investment options and the flex to invest directly into ASX-listed shares, ETFs, and more. Superhero Super is primed for performance. They were recently crowned winner of excellent rates and fees, best for direct investment, and runner-up for retail superannuation fund of the year at the Wee Money's 2024 Superannuation Awards. Remember, Superhero does not provide financial advice, so consider whether their product is right for you. Superhero Super is a sub-plan of One Super, which is issued by Diversa Trustees Limited as trustee. Read their PDS and TMD and download the Superhero app at superhero.com.au.
A reminder that on Wednesday, the 10th of July, we are coming to Melbourne to do a live podcast. We cannot wait. The evening is going to be highlighted by a live Pimp My Portfolio session where Ren and I will be going through our portfolios, every single position, with Luke Larrative to get his thoughts on how we might be able to improve our portfolios, just like we do it with community members on the show. So if you want to see what is in our portfolios and see if Luke can roast us, then come and join us at our live event in Melbourne. We're also doing an Ask an Advisor session as part of it, where we'll be bringing in Dylan, one of our advisors, where you can answer all of your questions from the night, as well as we'll be unpacking the news headlines just like we normally do on the show. So come and join us. It's Wednesday the 10th of July. Tickets are available at equitymates.com/events. I think there's only about 20% left or so. So make sure you grab one. We cannot wait to see you there. All right, Ren, so where do we want to start with Zip?
Let's start with the question.
Okay.
Is Australia's number one meme stock back?
I don't know if Zip would like to be known as Australia's number one meme stock, but no.
Okay.
No.
do the stocks get to choose?
No, they don't.
Did GameStop or AMC get to choose if they were a meme stock?
No.
And I think name more of a meme stock in Australia.
I can't think of one, to be honest.
Yeah.
Well, to answer your question, Ren, maybe. So in a month and a half, it rose 133%, and that was from January 2021 to mid-Feb of 2021. It went berserk.
So Zip had like a great run. So it listed in 2016.
Yeah.
And it had a great run as a buy now, pay later company.
Yeah.
But then that period, January 21 to mid-Feb 21, and that was after Afterpay had
Yeah,
run.
yeah.
And so everyone was on the buy now, pay later
we need to
hype.
go, yeah.
And then it just went bang.
Yeah, it went straight up. 133% in a month and a half.
Got to like what, $14?
About that, yeah. Yeah.
Unfortunately for Zip, it then fell.
Yeah, so it fell 97% from its peak in 2021. But, Ren, you asked the question, is it back from November 2023 to today? It is up more than 200%.
So
it's been a slow turnaround story, but a turnaround story nonetheless.
yes.
They've made a lot of acquisitions, which we'll get to soon. But yeah, is it back? Maybe.
Yeah. So it's about $1.26 time of recording. So for people that bought right at the top and held on, they are down.
And it was down in the 40 cents somewhere.
Yeah.
What a ride if you were on that. If you were on that buy now, pay later. And the reason that we're talking about it today is because it is one of the most traded on the Superhero platform and a stock that continually gets spoken about, particularly in moments like this in the Equity Mates community where it pops its head up, goes on a bit of a run, and people ask, "Is it back?" But if you've just joined us and you have no idea what Zip is, let's do a bit of a company overview.
Yeah. Buy now, pay later was a great idea.
Awesome idea.
It was really a product of like, it was better than what came before it, and over time it inherited a number of the problems that it was trying to solve.
So you're saying it was better than a credit card?
Yes.
And over time it became a credit card.
Essentially. Yeah. I would, yeah.
Very close to one. In fact, a lot of the buy now, pay later operators offer credit card-like products.
Yeah, well, Zip has introduced their own called Zip Plus, but we'll get to that.
Okay.
So, but it's a buy now, pay later company, and for people unfamiliar with that, it essentially allowed people to buy something and then pay it off generally in 4 installments over time.
Interest-free.
Interest-free.
Yes.
Yes.
Yeah.
It was founded by Larry Diamond and Peter Gray in 2013 and listed on the ASX in 2015. I think I said earlier that it listed in 2016, so I was wrong. The often forgotten part of Australian buy now, pay later history is that Zip was first.
Yeah.
So Zip was founded in 2013, Afterpay was founded in 2014, Zip listed in 2015, Afterpay listed in 2016. So let's give Zip its credit.
Credit where credit's due.
Pun intended.
The stories are very different in terms of the ending. well, not the ending. They're both actually still active.
Neither story has ended.
They're both actually still active. It's just that Afterpay managed to sell to Block in 2020?
Yeah.
Yeah.
We're going to get to the financials later, but if you took the share price away and you just looked at the financials, you'd be impressed. Except for the fact it's not profitable, but like revenue, you'd be impressed.
Okay.
But that doesn't tell the story of the share price, obviously.
Yes. Yeah.
So let's tell the story of what happened as a publicly listed company.
So 2016, they started an acquisition spree. So they acquired Pocketbook in 2016. Then to expand globally, they acquired PartPay in 2019, which helped them open up in New Zealand and the UK. Then to push into the US, where it was thought there was a much larger market for buy now, pay later. In fact, Australia started the buy now, pay later phenomenon.
Did we?
Apparently.
So Australia claims it, but then there's Klarna, which was Swedish.
So I've actually got some notes down here a little further. They are the largest buy now, pay later market share. So that might... Klarna, yeah.
And Klarna was founded in 2005.
And they're Sweden. Okay. So we didn't. So we're doing the old Lamington.
Russell Crowe. What else do we claim from New Zealand?
The meringue? No, that's Aussie.
Isn't it? I don't know.
Or the pavlova?
Oh,
no.
Have I got that wrong? It's not Lamington, it's
I think
pavlova.
It's the pavlova.
Oh, yeah, that sounds right.
Yeah. Anyway, nonetheless, it was one of the first.
It was, yeah.
It was up there. Anyway, so in 2020...
Anyway.
In 2020, they acquired QuadPay to expand...
Sorry. Affirm, which is the US one, founded by the ex-PayPal guy, founded in 2012.
Shit.
So we actually weren't first or second.
All with buy now, pay later as the first model?
Affirm?
Yeah.
I think so, yeah.
Okay.
Yeah.
All right. Well, okay. Well, then take that back. We were top 3.
Look, we were the best.
We were probably the biggest uptake.
Put it this way, we listed before Klarna or Affirm.
Perfect. There you go. That's what the stat probably
Affirm
says.
listed in 2021, like the bull market was half done by then. And Klarna, they listed, oh, you know what? It's still privately held. They missed their IPO
And
window.
didn't Combank get in on Klarna?
Yeah, when Klarna launched in Australia in 2020, it was with Commonwealth Bank.
In conjunction with.
Yeah, so there might have been some investment there or something, but yeah.
Nice. So back to the story. They bought QuadPay in 2020 to go into the US. Then in 2021, bull market was roaring. They acquired Middle Eastern buy now, pay later companies Spotty and European buy now, pay later Twisto. So they bought to try and just get global presence.
Which is a good capital allocation decision if you know that if you're buying with all scrip and you know that your shares are massively overvalued.
Yeah, so it
wasn't dumb, is what I'm saying.
But then since then,
but
the market has cooled.
Even if that's a good capital allocation decision, if you're buying unprofitable companies, then you've got to support their cost base.
Yeah. And that's where it became a little bit challenging. They've subsequently started winding up or have wound up operations across Singapore, UK, Pocketbook is done, and Zip Business Trade as well. So really bringing it back. And I think Larry moved overseas to focus on growing in the US and just consolidating that market. Now they have a global CEO and an Australian New Zealand CEO, which I think is still Peter.
Yeah, so the founders are now CEOs of the respective countries. Larry US, Peter Australia and New Zealand, and then it's Cynthia Scott who is the group CEO, and she's got like a very corporate CV. She was at Telstra for a while. She was at Centre Group. So like she's the experienced ASX leader.
Yeah. So that's what it was. Ren, what is Zip today?
What is Zip today? Other than being back, you mean?
Yes.
Allegedly. So Zip today really has 4 key products. It's still a payments player at its core, and that's what it's still doing. So it's got Zip Pay, that's their classic pay in 4 product. Then they've got Zip Money, which is a bit more, I guess, of like a flexible product. It's a digital wallet that can give you a line of credit up to 30 grand. Then there's Zip Plus. Now, this is kind of like a credit card model. So it's a line of credit with an interest rate of 12.95% if the balance is above $1,500 at the end of each month.
Yeah, so does that mean you don't have the interest sub $1,500?
Yeah.
Okay, I see.
So compare it to a credit card, and this is how I started by saying it's better than, but it also replicates some of the challenges that came before it.
Yeah.
Compare the pair, credit card, 19.99% compared to 12.95%.
Yeah.
So a better interest rate for Zip than a credit card. And a credit card interest is charged on any balance over $0 at the end of the month, whereas Zip is any balance over $1,500. I think you can't argue with the fact that buy now, pay later has made it less costly than a credit card, but at the same time, there is still a cost. You know, like this consumer debt puts people in bad financial situations, and it's expensive.
Yeah. It doesn't make it a more right financial decision.
Yeah, and it's tough because the credit card players and the buy now, pay later players can point to examples where their services have been the difference between people having like far worse outcomes.
Yeah.
You know, like they've kept the lights on, or they've paid the rent, or they've covered, you know, some necessary expense that was needed. Sure. And I don't think anyone would argue with that. It's just that the majority of your transactions aren't that.
Yeah.
The majority of your transactions are wants, not needs, and put people in bad financial situations.
So that's Zip Plus, and then to close.
And then finally, there's a business Zip Business Capital.
So that's the 4 products. Let's have a look at their some of the stats for FY23. There's currently 6.2 million active customers with Zip. If you put that in perspective, globally, there are currently about 360 million buy now, pay later users, expected to grow to 900 million by 2027. Of that, Klarna have about 147 million.
Affirm 11 million, Afterpay 10. So Klarna is just dominant, early to market, and one of the biggest players.
I had no idea that they were that much bigger.
Just enormous,
Yeah.
yeah. Well, I think, again, you said, so they're a Swedish company, and the Swedish market share, it's huge apparently. 72,000 merchants on the platform. They do 72.7 million transactions a year, 8.9 billion in transaction volume. So that means the purchases through the platform are to the tune of about $9 billion. And they made about $693 million in revenue in FY23. So they're definitely playing in a big market, a growing market. 16% of 18 to 34-year-olds use buy now, pay later. Almost half of the US citizens are interested, and I think about a quarter use it. Big growing market. So you can understand why Zip turned to the US as a major focus. And of course, Afterpay being bought by Block and Affirm. But yeah, Klarna, the biggest player in the market by far.
Yeah. So let's talk about financials, and then we'll talk about the future, because I think we're touching on some elements of the future there, but we don't want to go too deep down that rabbit hole. So earlier I said if you just looked at their financials, you would be impressed. The company listed in 2016, and if you'll indulge me, I'm just going to read their annual revenue number each year from them.
Go for it.
3 million, 16 million. You know what? I'm not going to say million every time.
Okay.
All numbers in millions. 3, 16, 39, 82, 160, 394, 597, 693.
Wow, that is, if you can indulge me further, can you give me the percentage growth rates?
I can.
All numbers in percentages.
Let me do the maths in my head quickly. All right, I've got it. 462%, 139, 109, 95, 146, 52, 16. Now, you could say that growth rate is slowing massively, but law of large numbers, like, it's a lot harder to sustain a constant growth rate.
Yeah. Pretty decent, and particularly through the bull market years, there's some solid revenue growth. Has it translated to the profit line?
So Zip has never been profitable. Yeah. So no.
Yeah.
Last year it lost 377 million, but that was better than the year before where it lost 1.1 billion. The year before that, 678 million. The year before that, 20 million. So it was a big step up in those COVID years.
Well, that was acquisition fueled.
Yeah. That was that comment around when you acquire someone, if they're losing money, you have to support their cost base.
Yeah.
But yeah, like, that revenue growth rate is seriously impressive.
Yeah.
But really, in terms of key takeaways from these financials, and to answer that question that we started with, is Australia's number one meme stock back? My answer is not until it's profitable. But if it becomes profitable, the market will change its mind on it, I reckon.
Their slide here says that the ANZ business is profitable. So maybe they're just waiting for the group. You're right. Once the group, it's the Americas really that they'd be looking for to turn profitable, and then away you go. Yeah.
So as we close out our section, I guess the question is, what is it going to do to try and become profitable? What does its future hold? And for me, the original bull case about buy now, pay later is still the unrealized dream of the sector.
Meaning?
Taking a meaningful chunk of credit cards' market share. So in America, according to the Federal Reserve, 82% of adults had a credit card in 2022. In Australia, I don't have the percentage of Australians with a credit card, but there's 13.5 million credit card accounts open, and a lot of them are joint because there's 17.7 million actual credit cards on issue. So again, a huge percentage of its two markets have credit cards. And the original promise of buy now, pay later, when everyone got super hyped when you bought Afterpay at $2, was if buy now, pay later can take 10% or 20% of the credit card market, that is massive.
Yeah, well, as you're right, the thesis is certainly still, well, the opportunity is still there, and they've definitely built out their product suite to try and capture a lot of that, because there is a difference between your classic pay in full or having a credit card like Zip Plus that acts a little bit more like a credit card, you know. You'd be using it for different things. So
yeah, but that's where my biggest challenge with this company and this sector comes in. Buy now, pay later is a product. not a company. And I think it's really impressive. Like the entrepreneurs that built companies around it, it's incredibly impressive. Larry, Peter, Anthony, and Nick at Afterpay. It's a product that was very easily replicated. Like PayPal rolled out their Pay in 4 very quickly. Like there's no reason that any of the big credit card issuers, as long as they had like a digital wallet or something, couldn't do it. And these guys did the hard thing, which was building a company around a product. Yeah, or like even a feature, not even a product.
Yeah.
Now their challenge is like everyone can do it, so they've just got to take market share. They got to outcompete.
Well, that's in terms of what are they going to do, what does the future hold? So obviously grow in the US and Australia, two of their major markets, or their two markets that they're in. Grow product offering, as you said, take market share from credit cards and build out the product suite that they've got.
And here's my bold prediction to end it.
Yeah.
Much like Afterpay was taken out by a bigger payments company, it wouldn't surprise me if Zip got taken out as well at some point.
Yeah, I'd be interested to know who though, because to your point, everyone
PayPal,
already done it though.
Stripe,
And they're like almost the biggest in the world.
well, no, but yeah, they've already done the product, but they don't
And
have
the customers. Yeah,
Pardon?
and they've got the customers.
But do they have the same like? Does Zip's 6.2 million customers, are they the same as PayPal's? How many customers do you reckon PayPal has? Like quickly do
About 35 million.
Really?
Yeah.
I would think that's small.
No, it's for the credit card feature, not for buy now pay. Yeah, because they have. I could be speaking out of school here, but they're one of the biggest providers of now. They're very similar to the credit card thingy. I'm not sure. I'm not sure about the buy now pay later specifically.
Okay.
Yeah, there's different numbers for different product lines.
Okay, so overall, PayPal has 426 million customers.
Shit.
So they're big, but the question is like, who owns the next generation of customers? And I would hazard a guess that the buy now pay laters own more of the 18 to 24 demographic than PayPal.
Do you reckon?
I kind of reckon, yeah.
I don't know. I reckon more people are signed up to PayPal before they're signed up to a buy now pay later.
Maybe.
Yeah.
But anyway, like there's value in the
their customer
ecosystem
base
that they've built.
Yeah, absolutely.
And it wouldn't surprise me if a Stripe or a PayPal, someone in that payment space says, we'll scoop you up.
Well, that's a good place to leave it, Ren.
This series is proudly supported by Superhero Super. We wanted to tailor our super our way, and Superhero Super provided that flexibility. With a wide range of investment options, you can invest in professionally managed, balanced growth and high growth portfolios, or you can add a range of ASX listed shares and ETFs. Recently crowned winner of excellent rates and fees and best for direct investment and runner-up for Retail Superannuation Fund of the Year at the WE Money's 2024 Superannuation Awards, Superhero Super is a low-fee, award-winning super fund. Remember, Superhero does not provide financial advice, so consider whether their product is right for you. Investment limits apply. Superhero Super is a subplan of OneSuper, which is issued by Diversa Trustees Limited as trustee. Read their PDS and TMD and download the Superhero app at superhero.com.au.
Welcome back to Equity Mates. We're doing a deep dive on Zip, and we're really excited for this because we're joined by an expert who has been covering the buy now pay later segment longer than anyone else in Australia. So it is our absolute pleasure to welcome Jonathan Higgins, Head of Research at Unified Capital Partners. Jonathan, welcome.
Guys, Bryce, Alex, thanks for having me on today. Really appreciate the time, and good to get back into talking about a sector that was on the up, on the down, and back on the up again now.
I know. It's crazy. It is just amazing. The boom and bust cycle of the market is really exemplified here. So, Jono, before the break, we've spoken a little bit about Zip as a company, but we haven't spoken about it as an investment. So we really want to cover how you analyze it, what the bull case would look like, what the bear case would look like, and then, I guess what you'd be looking for longer term as an investor and sort of what milestones you want it to hit and what it might look like. So let's start with how we analyze it. When you look at a buy now, pay later company, what are some of the metrics that are most important for you and how are you analysing Zip?
Great question. And I think to set the scene, let's talk about firstly where buy now, pay laters come from and sort of the original value proposition, because I think it's very powerful in the context of what these businesses could be worth over the long term. So Traditionally, credit has been an area, particularly in Australia, but also globally, that's been dominated by major financial institutions. These guys are typically offering products like personal loans, credit cards, and the like when it comes to unsecured credit. They're charging anywhere from 20 to 25% per annum at current sort of rates. They're very hard to usually get in that, you usually have to undertake a credit origination process. You have to fill in forms, go through a whole bunch of offline stuff. Maybe 2 weeks later, they send you a physical card in the mail and all of a sudden you're then transacting, and the average person's transacting about $3,500 a month through these forms of payment. If you sort of flip it on its head, Buy Now, Pay Later's proposition was twofold. Number one, you can get credit in real time from anywhere from sort of $100 up to sort of $2,000 or $3,000 or $4,000 within a couple of minutes via a very quick origination process, via stripping your accounts, looking at some of the credit information that's available, and they can do it in real time. And then the second side of that was on the merchant side. Merchants could drive better conversion, higher average order values, and deliver really an expansion in basket size. Now, the reason why I flagged this is because the merchants are paying Buy Now, Pay Later companies to then acquire these customers who they then make money off, either via merchant fees, other fees, or via an interest-bearing product, as some of the Zip products have got. So why this is very powerful is that, effectively most forms of origination require you to pay Google or an affiliate or something a fee. These companies at its core are actually paid to take customers and then potentially over time offer them services. So, the biggest metrics that you look for in the early stages of the growth in these businesses is the adoption curve. So what we saw prior to COVID and then during COVID was things like active customers. We were looking at active customers, how much they're transacting, how frequently they're transacting, what methods, and then the transaction or TTV, total transaction volume or TTV of these businesses. And they were really getting valued off that. The sector's now matured a lot. There's now really a focus upon both profits and also margins. We're into the stage of the cycle where we've been past the early adopters. We're getting into the stage of the cycle where you need to make money. There's a cost of capital involved with it. And so what's really in focus, the key metric that all these businesses are running at the moment is either on a cash earnings basis or a net transaction margin, or NTM, as Zip affectionately calls it in their presentation, which an NTM margin is effectively your revenues that you're generating from your customers and your merchants, minus the costs of doing business on a variable basis. So that's things like your interest costs on your debt, your bad and doubtful debts costs, as well as your processing and transaction costs. And investors should think of that as being the gross profit of the business. And so that's really in focus, consolidating that metric. If I could just take a moment just to talk about the sector. Look, globally, they were all happy-go-lucky prior to COVID. There was plenty of blue ocean. There still remains that. But then we headed into COVID. Interest rates dropped. People started to promote. All of them started to fight at the checkout. Exiting COVID, there's now a cost of capital. So what we are seeing globally, out of all the major players, your Affirms, your Klarnas, your Square, which is Afterpay, your Zip, is really capital discipline and returning to sort of profitable yields, putting in fees and the like. And we're seeing the whole sector starting to raise net margins across the group. So if there's two things you want to look at as an investor over the next 12 to 24 months, it's net margins, because that'll create your profit, and then it's cash EBITDA, which is your discipline against your operating cost base.
Fascinating. Well, we want to turn to the bull case, and you spoke a little bit there about the industry, but it certainly feels like, post-COVID and the acquisition of Afterpay, which is probably going to go down in Australia as one of the greatest exits of all time. But we've seen Zip go from 40 cents to $14 and right back down again. So when you're thinking about the bull case for Zip, what sort of foundations go into that? And I think also, like, from an industry point of view, like, what's the bull case for the industry as well?
To come at the bull case, it's interesting to use Australia as an example. We're very rarely the tip of the spear when it comes to technology, but in financial services, we can be ahead of the curve, and Buy Now, Pay Later was one of those things. What we've seen in Buy Now, Pay Later in Australia is roughly sort of 40 to 50% of people in Australia have used Buy Now, Pay Later at any one time. And out of the younger cohorts, think people that are less than the age of 50, that penetration rate rises to sort of almost 60% of people. And the average customer in Australia is transacting with Buy Now, Pay Later every quarter, anywhere from sort of $400 to $1,000, and average is sort of $600 to $700. Now, the reason why I give you this reference is Buy Now, Pay Later is an Australian innovation. It's gone global, and we're now seeing this starting to be adopted in the likes of the US, Europe, the UK, and emerging markets. And the bull case is very much that we take levels of adoption that we've seen in Australia and we see those levels of adoption rise and see penetration in the US. So right now in the US, on sort of a like-for-like basis, the current rate of penetration is more like 20 to 25% versus sort of that 50 to 60 you heard me talking about. And the average customer in the US is spending about a third less. So there really is an opportunity for these businesses to get 3 times the size based on people using it 3 times as much. And there's also the opportunity for there to be twice as many customers in what are large markets. You know, Australia's a market of 20 million adults. America's 200 million adults, for example, and they have a higher rate of online spend. So the bull case is that they take these penetration rates in buy now, pay later, and they expand them globally to do it. And the bull case against this, very much the bull case against it, is they're taking a fintech-like mentality to do that, in that you've got a basis where like these businesses don't have branches, they don't have a lot of staff, they're taking a digital and a fintech mindset, and they're charging really strong risk-adjusted returns. So I'll touch on this in that your typical bank, if they're a great bank, the best banks in the world are all in Australia in terms of their returns. They charge anywhere from 1.9 to 2% on the net interest margin above what their cost of funding is. If you look at the buy now, pay laters, and we'll use Zip as an example, Zip in Australia has an adjusted revenue yield of about 18 to 19% per annum, and post the cost of goods sold and the like, they make a effective yield each year sort of north of 6 or 7% per annum. In their US business, where the receivables rotate quicker, they make an adjusted margin of over 2% on each transaction, and they rotate that 12% a year. So on a like-for-like basis with banks in Australia, they make 7. In the US, they make over 20, and your traditional bank makes over 2. So these businesses should, and if they can keep their margins where they are or increase their margins, they should be highly profitable, make huge profits at scale, and deliver a real capital efficient way of undertaking their businesses. So the bull case is that they generate significant penetration. We're starting to see that at the moment. The average sector growth rate's about 30 to 35% year on year at the moment in the US on some large companies. Zip, I think in the last quarter was growing 45%. So, the bull case is that you get, significant above market rates of growth and operating leverage and operating profits at scale. And that should generate hundreds of millions of dollars of cash EBITDA, hopefully on an annualized basis for Zip a couple of years out, and hopefully a share price that's well in excess of the current share price of the group.
Wow. God, that's exciting. Just from a content point of view, if Zip comes back, we're going to have podcasts for days over here. Just following up on the bull case, you gave us those 2 metrics earlier, net transaction margin and cash EBITDA. How does Zip compare to some of the other buy now, pay laters in the sector on those 2 metrics?
Yeah, look, it's a great question. Look, they're all not created equal, would just be my first comment. If you're looking at Afterpay, they're still running predominantly a pay in 4 type model. Zip runs a pay in 4 type model in the US. They've just launched a pay in 8 model. And in Australia, they have a digital wallet, which rotates twice a year rather than 12. So it's not all like for like, but they do compare very favourably, would be the broad brushstrokes to the question, in that you've got a business that right now is, I think, making a 3.9% net transaction margin. So that means that on every dollar of transaction value they do, they make 3.9% of that as a gross profit number, and then they put their corporate costs against that. That's up over 100 basis points in the last year. And you heard me speak earlier around how some of the costs of fund, the things that go into that net margin on the cost side is costs of funds, which is interest rates. We've seen interest rates been going up globally across the world for the last 2 years. It's been very painful. And it's also bad debt. So in the context of the consumer getting tougher, interest rates going up, their margins have been going up aggressively as they've been repricing and becoming more rational in line with the sector. So they would just about lead the sector. They'd be roughly comparable to Affirm, which is a US listed business, which looks very similar to Zip in terms of on a global basis. And they'd be ahead of the likes of your Afterpay and the like, which run more at sort of your 2 to 2.5% net margin. The difference being your Afterpays of this world and your Sezzles, these types of names, they have products which just typically focus around the pay in 4, whereas the benefit Zip has is they have a very wide platform. They'll offer you an interest-free, they'll offer you a digital wallet, they'll offer you a pay in 4, a pay in 8, and they'll all do it all in the idea of their ecosystem, and they've been very successful over that. And as we're seeing the world start to focus more on credit, that's becoming more in vogue with companies like Zip as well.
So let's turn to the bear side of the story. If you were to start to poke holes in the bull case, or just if you were to sort of point to like key areas of risk for the sector and Zip in particular, where do you start?
There's two bear points, and it's very easy to come up with bear points after you've watched what's happened to the sector over the last sort of 5 years. So I'll caveat that with saying that it's been well and truly turned over. Look, the first is on sector discipline. You know, although there is blue ocean currently in evidence with what we're seeing in buy now, pay later, they're all sort of getting along pretty well. They're not fighting each other. The reality at the end of the day is they operate in global markets. They have global competitors. And so, you know, if there was a predisposition to these businesses to go back to competing very heavily against each other, you could see irrational competition, and that would erode sector margins, net margins, and that's something that investors globally wouldn't love to see, and definitely the investors of Zip wouldn't love to see. It doesn't mean that they can't still do well in that environment, but it's much better when they're all sort of acting a little bit cozy and getting along. So I think the first one to identify would be sector competition. I think that's somewhat limited, just to add on that at the moment, because the cost of capital is so high at the moment. I think people do have to act rationally, and you'll see that continuing across all the emerging sectors, technology, buy now, pay later, and the like. So I think the first is sector orientated and just sort of the discipline there. The second would be on the macro side of things. So, you know, these businesses do credit. They do have leverage to retail sales. They do have leverage to transaction volumes and the like. Now, they're typically, merchants want to offer these products. You usually get a higher basket size, you get better conversion, and you get more revenue through the door. That's what every retail merchant wants. And so they're happy to offer it. But on the flip side of things, on the credit side of things, these guys have debts. They have bad debts that could occur, and they have interest costs associated with what they're doing. So, I mean, very significant changes in the macro environment where we saw, you know, like unemployment rising at a healthy clip. These are things that typically are associated with higher levels of bad and doubtful debts, and that could adversely affect both the profitability, but probably also the sentiment. Right now, what we're seeing globally is very low levels of unemployment. Whilst inflation remains high, you know, the reality is that everyone's sort of tracking along pretty well. We haven't seen any interest rate cuts just yet. They're not. I don't think they're as on the horizon, but in the context of things, if you saw a significant decline in credit quality, that would be something that you should be watchful of in the sector, in that because it could affect the margins and really the sentiment in the sector. Nobody likes investing in financial businesses when credit starts to go bad, because credit investors do have a senior position in the capital stack of all these businesses above the equity investors.
So, Jono, just to close out, we want to ask about what it looks like over the next 10 years. Like, where do you think Zip could get to? Also, the industry. We spoke earlier in the episode about the, you know, credit cards and what it looks like relative to credit cards. Are they just straying back towards a credit card model, or, you know, how is the industry going to play out? And I guess everyone listening is going to be wondering, is it ever going to hit the heights of 2021?
Well, it depends if you're talking about, you know, the size of the business or, you know, potentially the share price. I mean, they're two different questions. You know, the heights of 2021 had, you know, for all the competitors in the space, lesser issues of shares. They were priced on EV to sales multiples that were 10 times what they were today. You know, they were very much in an environment where capital was very much free. And so it would be difficult to see them trading to multiples like that again. But I think near term, you could see the multiples of the sector probably expand by 2 times if they continue to get a tailwind. And that probably, and if we get interest rate cuts at some point, I suspect that, you know, that could accelerate. So I think in the near term, you should expect really strong profitability, potential multiple expansion. And if we do get some interest rate cuts, people will really flock to the sector as they've got leverage on it. In the longer term, in answer to your question, look, I mean, I think all these businesses in the next 5 years should be sort of 2 to 3 times their size. It's very rare to be able to see a sector that's got structural tailwinds in that. And I think that's just based on their current product constructs and a little bit of iteration. Over the next 10 years, I think that these companies, like I've always thought, should be the originators of credit across the world. I think that the traditional credit card model is broken. It's expensive. I think it's reasonably predatory to customers in that it's designed to make you incur interest. And I think things like fintech businesses are well placed to be the originators of choice. And I draw a parallel to things like mortgage brokers. The reality is anyone who can offer you a mortgage, you don't really mind where it comes from. A mortgage broker will do it quicker, better, faster, and offer you a better rate. Buy now, pay later should be the same across all personal credit. And so that should be pay in full. That should be going and getting a personal loan, potentially doing a car loan, or maybe even providing a reference on your mortgage. So these are the next 10 years because they're just much better at doing it. And for the banks, it makes sense. They can finance it. They don't have to have the 1,000 branches or whatever it may be. They don't have to have the cost base. They deal with one counterparty instead of 2 million counterparties. So, the proposition in fintech remains. Whether they get there in 10 years or they're snaffled up by the major banks as part of that, I'm not sure. I suspect we do see sector consolidation over the next 12 months as now the businesses cast their eyes towards growing post shrinking and consolidating. Zip, for example, has probably the lowest multiple in the sector. It would look very comfortable inside one of the larger major peers in the US and would, effectively be a rounding error in the context of their market cap. So I think be positive in the short term, be watchful across the environment, and really I think we still remain at a very low level of penetration, and I think we should expect the sector to continue to perform. There has really only been 2 years in the whole sector's life where it's performed poorly, and that was during interest rates going up at their fastest pace in the last 40 years. And so I think give it a pass, and just give it a pass on that would be my view.
Yeah, it is fascinating. The numbers about credit card penetration, even today, are just crazy. I was just looking them up. It's like more than one per household in Australia. It's something like 80% in the US have a credit card. It's crazy. So there's opportunity there, and we can't wait to see how it all plays out. But Jonathan, thank you for joining us today. We really appreciate it. And as this Zip story pays out, I'm sure we'll be getting you back on to talk about it more.
To the moon.
Excellent. Thanks very much for your time, Bryce and Alec. Cheers.
We want to say a huge thanks to our friends at Superhero for supporting this series. Superhero Super has given us the control that we want to manage our super. Superhero Super is primed for performance with a wide range of investment options, including professionally managed portfolios, thematic, and direct investments accessible in an intuitive app. Download Superhero's easy-to-use app and start tailoring your super today. Remember, Superhero does not provide financial advice, so consider whether their product is right for you. Superhero Super is a sub-plan of One Super and is issued by Diversa Trustee Limited as trustee. Read the PDS and TMD and download the Superhero app at superhero.com.au.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.